Hi guys, welcome back. Today we're going to be looking at Nvidia and whether this company is a buy. Recently, the company has seen a very big revenue ramp because of the strong demand for their GPUs, and right now is a great opportunity with the market to grow its cryptocurrency mining business as well by selling dedicated processors. However, the valuation for the company is quite expensive with a PE ratio of 77 and a price to sales ratio of 15. Today we're going to be looking at whether this company is a buy. If you do enjoy, consider subscribing. We are very close to 200 subscribers. It is free and it does help me out a ton. If not, thanks for watching anyway. On to the video. So the first thing we'll be looking at today is the Q1 earning reports that Nvidia recently released. So Nvidia's management has expected the Wall Street to come up with a $5.3 billion estimate for its revenue for Q1. However, Wall Street was slightly more bullish and expected a figure of close to $5.4 billion. However, Nvidia beat expectations by posting a revenue of $5.66 billion during the quarter, which was a year-over-year growth of 84%. Between this, its gaming sector grew to $2.8 billion, which is a 106% year-over-year growth. Its data centers grew to $2.1 billion, which is an 80% year-over-year growth, and its professional visualization revenue grew to $372 million, which is a 21% year-over-year growth. The only one out of its four business models that failed was the automotive sector, which stayed flat year over year. So where does the future growth lie for Nvidia? So data centers has quickly emerged to be Nvidia's second largest profit maker. Sales are up to $2.05 billion in Q1, which is up more than a respectable 79% year over year. Data centers operate behind the scenes, but it's very important in the computing units of today's world. They operate on the internet, mobile networks, and countless software services built within larger connections. They coordinate real-world activity like managing postal services and healthcare information as well. As the digital world becomes more and more sophisticated, better hardware is required to coordinate all the new data that is processed. So lots of companies are adding GPUs to their data centers designs as well as computer accelerators and using GPUs to replace their older CPUs with faster and more efficient GPUs as well. This space was traditionally dominated by Intel, but recently Nvidia has been eating into Intel's market share as it becomes more and more profitable with their more energy efficient GPUs. Last year, Nvidia unveiled a new specific processor, the DPU, the data processing unit, and this was announced in early 2021 that they will have a CPU called Grace to pair with its GPUs as well to have a more integrated feel with data center applications like AI. Just like its gaming business, data centers show no sign of stopping in the near future, as CFO Colette Kress said that during the earnings call, every industry is becoming a technology industry. There's no shortage of growth opportunity for Nvidia, especially as cloud-based services and AI and companies in this regard unlock new and more capabilities, and data centers become more required than ever before. On top of this, cryptocurrency mining is also very GPU intensive, and a lot of gaming GPUs are used to mine cryptocurrencies as well. Nvidia last year even tweaked its software during the pandemic to discourage this behavior and stabilize the market of GeForce graphic cards to the gaming community. But that also means that Nvidia has an exceptional growth opportunity at its hands by producing dedicated cryptocurrency mining processors, or CMPs for short, in which demand is extremely high. Since cryptocurrencies have been exceptionally volatile over the last year or so and demand is at an all-time high, mining for cryptocurrency has become more and more lucrative, which means that the demand for CMPs is growing and it can become a very profitable venture for Nvidia as well. Another room for growth is in semiconductor. Nvidia, of course, makes money on with the sales of their semiconductors as well. They have licensing revenue from selling chip designs and have also recently are recently going to acquire ARM holdings by early 2022. Cloud-based recurring software as a service revenue is also very promising for Nvidia. It has an auto industry platform, which is a prime example of this. As mentioned previously, auto revenue was flat year over year with the Q1 revenue of $154 million as Nvidia continues to exit commoditized vehicle in infotainment hardware. But its Drive autonomous vehicle platform spans not just to hardware but for software services as well, as this semiconductor licenses that they sell help automakers and autonomous vehicle researchers advance stuff such as self-driving and safety capabilities as well. Another example of their semiconductor growth opportunity is Omniverse, which is a new software platform that they released. Omniverse has been open to beta, but will have a more commercial launch this summer. In the beta testing phase, there have been more than 17,000 downloads, showing that the demand is there for a service like Omniverse, and it shows that there is a robust demand for a software as a service based business line as well for Nvidia. Software sales will be a more long-term development for Nvidia, as currently they're focusing on GPUs and data centers, but it is a very exciting outlet for Nvidia as it pairs very well with their GPU processing unit, with their graphics processing units as well. Nvidia is innovating extremely fast right now and are spreading their influence into many different sectors, and I wouldn't be surprised if Nvidia becomes a very powerful company over the next few years. The next thing we're going to be looking at is Nvidia's financials. We can see the net income has been consistently increasing, so that's a very good sign. Its earnings per share has also hit an all-time high of $8.46, and over the last few years has been growing exceptionally, another very good sign for the company. Its dividend of 0.64 cents has a payout ratio of about 7.6%. It gives us it also gives us a dividend yield of less than 1%. So I wouldn't necessarily see it as a dividend stock, and I wouldn't see it as a bonus plus, as this money could be better used by the company. But it's not exactly a negative that the company is giving a small dividend as well. Its book value per share has been again hitting an all-time high of $30, but nowhere close to the actual share price, so it wouldn't be considered an asset play either. Its operating cash flow, cap spending, and free cash flow have all hit all-time highs, with more money being coming into the company, more money is being invested within the company as well, and more money is being kept for future ventures as well. Its net margin is very healthy at almost 28%, especially for a company that manufactures stuff. It's very healthy. Its return on equity of 33.5% is also very good use of shareholders' equity. Shows that the company is using its money very efficiently, and it's very profitable to the company as well. Its interest coverage is close to 27 years, and its debt to equity is less than 0.5 at 0.35. So that shows that the company is very conservative with their debt, and for any future ventures, it will not necessarily hurt the company to take in slightly more debt, as it is clearly covered by their shareholders' equity as well. One negative is that their price to earnings is extremely really high, with a price to earnings of almost 77 years. And their price to sales is also skyrocketing at 15, with a PEG ratio of more than 3 as well. So the company's stock price is extremely overvalued in this regard, and their future growth is not exactly worth the stock price it's trading at right now from purely a valuation point of view. But however, from a technical analysis, we can see that the company has been performing extremely well. You could see at the beginning of 2020, or after the March crash, the stock was trading about $215 and is now trading at an all-time high about $650. You could see about a few weeks ago, or about a month ago now, the stock was trading at about $550, and since then the stock is up more than $100 in a very short amount of time. But I would say that the stock is quite overvalued as of right now. Even from a technical analysis, it's quite a bit higher from its 20 and 50-day simple moving average, and the valuations from the previous slide don't really help its case. But if you do want to invest, I would suggest somewhere near the 20 or 50-day simple moving average, somewhere around the $600 zone would be a good entry price. And especially with this very cyclical nature of the stock coming up and down every few months, I wouldn't be surprised if over the next few weeks or a month in the future, the stock does correct, and that would be a good time to enter the market. So just some final words. Nvidia has extremely good future growth with its data centers, its GPUs, cryptocurrency, and semiconductors as well. It has solid financials, is profitable, and is using its shareholders' equity, and is to a very good standard as well, with low debt. However, its valuations, I feel, is a bit out of my liking. It has a price to sales of 15 and a PE ratio of 77, and is trading much higher than the 50 and 20-day simple moving average. It would be a buy in terms of a long 5 to 10 year hold, but it is extremely expensive, so I would put a target price close to the $600 or $605 mark. So if you do choose to invest, make sure to do your own due diligence, and thanks for watching. Bye.